Hello and welcome. My name is Benoit Padiquet. I'm the founder and one of the portfolio managers here at Exponent Investment Management. And you're watching the second quarter of 2022 quarterly review. This is the in-depth version of the video where we're going to go through a lot of the quantitative charts. In the first video, reviewing this quarter, we talked about the emotional toll that volatility can take on an investor. And we're going to go in depth with this video in terms of what happened and where do we go from here. So let's get started, shall we? So how did we get here from volatility perspective? In two words, past decisions. We are going through the investment markets are reacting to previous decisions. And these decisions, and I'm not going to question these decisions, they were made, with the best information available, if you will. Some of them were political at the time, but now we're kind of left with sort of the aftershocks, if you will. And these decisions really resulted in the flow of goods and people and commodities. Basically, you're trying to move them from where they're being produced to where they're required. And the decisions of the lockdowns, if you will, really stemmed the flow of that. And we're still suffering or living through some of those impacts, if you will. So what do we mean by that? Well, the net result is when there's not enough supply of a certain product or good or service, more people want it, or the same amount of people want it, but there's less of it around, so prices go up. It's called a supply side recession, and we've really kind of suffered through that for the first half of 2022 and most of 2021 as well. So if you try to buy a sofa, a car, an RV, sometimes just peanut butter, you just couldn't find it. And because these decisions around the pandemic were both uncoordinated, both between provinces or between states or between countries, and they were unpredictable in nature, what human beings tend to do when they're faced with uncertainty is they tend to hoard. They tend to want to build up inventory. The old story about the beginnings of the pandemic of people going to Costco and Walmart and whatever, and grocery stores and trying to hoard paper, toilet paper of all things, is a great example of there's a natural instinct of wanting to hoard when there's uncertainty around the supply. And the problem is it's most of the end of 2021 and early 2022 was the wrong time to build up inventory in the sense that demand was uneven, supply was uneven, and prices were high. But nonetheless, as humans, we all have sort of problems around how we're built together, or put together, I should say, and so we hoarded. So a lot of companies, a lot of economic agents and consumers are starting to hoard or build up inventory. The labor participation is another interesting one. It's actually gone down. So at the margin, labor is a commodity. And if you have, during COVID, you had sort of a big wave of, one can say, retirements, whether it was forced or induced or by choice, a lot of layoffs, a lot of sort of air pockets around the supply. And so participation in the labor market was reduced coming out of COVID and the lockdowns, if you will, the pandemic lockdowns. In many countries, the U.S. was less affected, but still is affected by it. You had an uneven re-entry into the workforce, whether it's because of family obligations or health challenges. The bottom line is you kind of at the margins had less labor coming back into it. So when you don't have enough, or you have less of a commodity, the prices go up. And then you had central banks who, going into the pandemic, really wanted to not have a replay of the 08-09 great financial crisis. And so they flooded the market with the financial markets with liquidity to make sure that the economic system wouldn't seize up. And that's entirely normal. And now they want to take out all this liquidity. And government interventions, they mailed out checks. They went through these large program spending, and governments tend to spend money until they can't. Politically, it's viewed as a good thing. And so you're having this sort of interesting situation where prices have risen, and like a Pavlov dog, central banks tend to just raise rates to curtail demand. So we had a supply side inflation problem. Central banks would call that transitory, and everything got up. So asset prices went up, but also the cost of living went up. So when that happens, central banks tend to raise rates to curtail demand. And that lowers asset values. And that's entirely normal. Why does it lower asset value? Well, we'll get to it in the next slide. But essentially, if a loan is more expensive to service, then the asset that is going to finance the person that is going to be financed by this new loan has to be reduced in terms of its cost, so that the price is in equilibrium, in other words. And now with higher rates, you introduce a demand side recession. So we've gone from a supply side recession to a demand side recession. So effectively, I have this little meme here. So central banks are like this poor fellow who's basically bailing this little boat, but has holes. And these holes are really government spending. And so central banks can raise rates all they want, and they can take out money supply and reduce quantitative easing. But if governments are spending money, they're kind of bailing a boat that still has holes in it. And that's really where, at the moment, where central banks, the situation that they're in. So why do interest rates matter? So here I have the 5-year generic government bond. So why 5 years? Most loans, mortgages are 5 years in terms of term. And this number goes back to, this chart goes back to 2002. So call it 20 years. So we're at 318 here in Canada, and we're basically still quite a ways from the 4.5%, 4.25% that we had pre 2007. But we've moved up substantially and quite quickly in terms of interest rates since the beginning of the pandemic, which was back here. Actually, the pandemic started in February, so central banks and interest rates started to fall at the beginning of 2020. All this to say is that interest rates are high. They're surely, from a historical perspective, not that high, but they're higher than they've been in the past 7 years. So why does that matter? Well, the price of a loan will increase. In other words, the interest rates affecting the payments values. So if the cost of carrying this loan goes up, then asset prices have to reflect the new costs of this loan. And so asset prices need to fall. So whether it's a car, a house, a bond, a stock, or a business, asset prices tend to fall when interest rates rise. So really, that's what happened in the equity market, in all markets, equity markets specifically, and bond markets. Interest rates went up. And so investors en masse had to reprice assets quite quickly. So let's look at the markets in Canada. So this is a chart of the TSX going back to 2017. So in previous quarterly videos, I've said that the TSX is basically traded in a box. So you can kind of draw a box here between 15,000 and call it 17,000. Going back, actually, you can go back further than 2017, but this is a pretty good illustration. So a couple of important facts here. Volatility is part of investing. So, how many times did the TSX move 8% or more? Quite a few. You can stop your video player and count them. And there's been quite a few times where the markets have gone down 16%, 37%, another 8%, so another 15%. So this drawdown here that we've experienced in Canada, down 16% from the peak, actually is a replay of 2018. So that was only 4 years ago. And then 2 years ago, we had a large drop down of 37%. Now, granted, this was due to a pandemic and a whole economic shutdown. My point here is it seems to me that we're really close to the levels that we were pre-pandemic in terms of index levels. And interest rates are going back to where they were pre-pandemic. So it only makes sense that if interest rates are going back to pre-pandemic levels, that asset prices are also going back. If we look at the US market, it's pretty much the same concept. You've got volatility here since 2017, the same chart of the S&P 500. We've had 9 times where the market has gone down 7% or more. So that's quite often. And markets are down nearly 5% from their, or 25%, I should say, from their peak in December. And we've had 3 large moves of 20% or more in the past 5 years. The point here is volatility is always part and parcel of investing. So the earlier video was all about the emotional toll of volatility on an investor. From a fact perspective, volatility is nothing new. It's always been part of the markets. Here's the technology chart. Same concept. We've had in the NASDAQ just a lot more volatility. It's a technology-heavy index, and technology stocks tend to be more volatile. And one of the reasons for that is that a lot of the companies in the index actually don't generate profits, or they're cash flow positive, but they're not generating net earnings. They're certainly not a lot of them are paying a dividend. And so what happens is that companies that are growing quickly, or their future profits are really expected later in the future, are very sensitive, extremely sensitive to interest rate moves. So that means that when rates fall, interest rates fall, tech shares tend to do very well. And conversely, when rates come up, tech shares really suffer the brunt of it. And it's a concept that is somewhat or easily forgotten, because technology shares and interest rates, most investors don't make the link, or rarely do so. The interest rate movements or volatility is more associated with bonds, which are often associated with a more stodgy, kind of boring investor set. But they're actually, technology shares are quite sensitive, very sensitive, in fact, to movements in interest rates. So many clients are saying, well, are we done? Are we there yet? So like a 5-year-old on a road trip, unfortunately, I can't make it better with trinkets from dollar store every hour. But the idea here is we look at certain indicators, and they're like gauges on a dash. And so a lot of these indicators will not tell you if you're at the bottom. They'll kind of tell you more or less situationally where you are in terms of market movements or market drawdowns. So we have 2 indicators that we look at. One is the moving average, the 50-day moving average. And what we're trying to see here is we're trying to see if how many stocks, as a percentage basis, are trading above or below their 50-day moving average. And of late, we're around 20%. And you can say that it's actually quite a rare occurrence. Usually that never happens at the top of the market. Let's agree on that one. I'm not necessarily saying that it's a call for a bottom, but it's important to understand that when you're at current levels, it's usually akin to close to bottom, if not a bottom, than a top. We have the same type of reading here for the Canadian market, and so here we've had a very low reading, and you can see that every time the market sort of hits a bottom, you have a low reading. And so it's not a predictor, but it's certainly a great gauge to understand where you are in the market cycles. Are we oversold? There's another indicator we'll look at. So you want to see the Bullish Index, another type of indicator. So sub 15 is kind of a level where it rarely happens here, and it always coincides with a bottom, not necessarily the bottom, but certainly readings like this never correspond to a top. Let's agree on that. Another indicator that I like to look at is the American Association for Individual Investors. So it's a survey of individual investors, so let's call them retail investors. And this reading actually really surprised me because it's never been this low. You know, you have the great financial crisis, you have the sort of tech wreck, all of these, big market moves. We can have 2018, even in 2018 when the market fell, it didn't correspond with a reading such as this. So again, not calling for a bottom, but these types of low readings do not happen at the top of the market. So when you hear us say that we're closer to a bottom than the top, now you know what some of the indicators that we're looking at. Now the counter to that is say, oh, well, gee whiz, Ben, market's really expensive, and the consensus has not come off in terms of writing down the earnings expectations in the face of a recession. And that is absolutely true. So this is the earnings expectation box from Bloomberg. So as the time of the recording, July 7th, the S&P 500 for the next year was the earnings expectations were coming from $199 to $239. So that's a 20% growth. We can agree that that number is too high. But if we're coming from $200, now maybe there's a 10% correction. So where does that leave the S&P 500? So then you're using fundamental analysis to try to build these guardrails around how low can things go. I've showed you some of the technical indicators. Now we're looking at fundamentals. And so you could look at price to earnings. You're in the 18, 19 range, dividend yields. There's all these valuation measures that you can use. And obviously the next year's earnings look quite low. So the market looks like a really good deal looking forward. So you can do a bit of math. Pause your video player and say, well, what if these earnings were $180 and the market wanted to pay, say, 18 times earnings? Well, the S&P should be trading around 3,600. We're at 3,800 at the time of the recording, so not that far off. Well, maybe you're thinking maybe the earnings need to be at $180, but you're looking at 15 times earning, which would be a very low multiple for interest rates. Well, you're looking at a 2,700 handle on the S&P 500, which is 30% from here. Now, I'm not calling for that level necessarily, but I think it's important to look at all different probabilities and what they look like. So if the pre-COVID low or high was 3,400, we're currently at 3,800. We know that the earnings are at $200. Maybe they go down 10% to 180. And that brings us at 80 times earnings. Maybe you're looking at 3,600, 3,400. So the technicals and the fundamentals kind of lead us to believe that maybe the S&P 500's bottom is, maybe we've seen it already, but it looks like 3,400. I've had discussions with other investors that feel that maybe it's lower at 3,300. It's really semantics at this point. From a general market perspective, the market has done, from a sell-off perspective, most of the damage, in my opinion, at the moment, with the information we have on hand. So what does that look like? You ask yourself, well, 10% retreat, that seems like a lot. Has it ever happened before? Well, the answer is yes. So here we've got the basic earnings per share of the S&P 500 going back to 1998. Now, since 98, we've only had retreats of 10% or more 3 times. So we had the tech wreck and the recession, and remember there was a terrorist attack as well in there. So there was a sort of deflationary bubble, and then you also had a terrorist attack on the U.S., which obviously curtailed consumer spending for a long period of time. And then you had the great financial crisis, and then you had COVID. But outside of those 3 events, earnings going down 10% has really never happened. So you need an external event of great significance in order to have a significant, like more than 10% earnings reduction. Now, the earnings have come down in the past. That's quite normal. They call them slow or shallow recessions. So that's entirely normal. But the big 10% earnings recession or more are rare. The other problem with looking at valuation as a timing exercise is that valuations don't really call a top or a bottom. So here we have the Great Recession, the market bottom in March of 2009, and valuations are quite high, which is kind of weird. The concept is foreign for most investors. And why is that? Well, during deep recessions, and I'm focusing on the word deep recession, valuations go up because not only do earnings come off, but companies tend to want to write down as much as possible. Investors are bracing for terrible news, and so it's a good time to sort of lower asset values from an accounting perspective. And so companies tend to have these special items or once in a quarter, or I should say once in a few moons type of write-downs. So markets that look expensive don't necessarily mean a bottom, but they also don't necessarily mean a top. So that's why valuation from a timing perspective are not that great. So at the moment, we're looking at 18, 19 times earnings, which is neither cheap, terribly, nor expensive. It's kind of average. So we talked about the financial toll or the emotional toll from investing in equities. And a lot of questions, a lot of investors might be asking, well, why bother? Why go through the pain? Well, why don't you just go to cash or buy GICs or whatever? And the reason is money actually doesn't exist. It's a concept. Money is really an ideal around facilitating transactions. And so here's what we've got is the M2 supply, which is essentially, it's called M2. This is the chart for the US economy. It's the white line. And it's a logarithmic chart. So you'll see some charts sometimes where they're not logarithmic. And it's a problem because as time marches, so this chart goes back to 1996. Each increase in $100 matters less as the base increases. The point here is the money supply, so the available money in the US economy has grown basically at 7.6% to be exact, annually. So if you stay in cash and make no return, or if you accept a low return through fixed income. Now, fixed income assets will make sense, but just understand that most investors, and we'll go through why, really need to have some sort of equity exposure in order to offset the effects of a growing money supply, because this M2 explains why my favorite quarter pounder combo used to be $5 not so long ago. It's now over 13. So people talk about inflation and don't really question why that is. Here's the why of the inflation. You have more and more money going into the economy as the economy grows. So I'll spare you the economic theory, but basically, as an economy grows, you have more and more money into it, but then the more money you have, it will chase a growing number of goods, but your purchasing power and your assets have to at least keep up with the growth in the money supply. So prior to the pullback, the markets were kind of in line with the growth in money supply. So there's some volatility, but you can see that there's a really big correlation between the growth in money supply and the growth in value of the equity markets. And whenever markets sort of come off this long-term range, they always self-correct to the downside. So let's go back to the real focus. This chart is very important, and that's why it was in the previous video, and it will be in this one. Now you can go to cash and go to guaranteed return investments. It makes some sense financially from a financial planning perspective, and even from a portfolio management perspective, as those assets usually lower volatility. They'll lower returns as well, but they also lower volatility. But they don't work when interest rates are going up. So they do not lower volatility when interest rates are going up. So if you can deal with the long-term volatility and map out your liquidity through proper financial planning, equities are still one of the best places to reach your long-term goals, which for most people is your longevity. You want to insure against running out of money. You want to ensure that you're able to meet rising prices. And for most of us, we do have a financial legacy to leave, whether it's our family or the world in general, in a better place. Nothing has changed from our view in terms of 2022 and beyond. I use this chart, I think, for the past 3 or 4 quarterly updates. I'm not being lazy about leaving it there. I'm just trying to convey that our focus has not changed. Dividends, at least shareholder friendliness by shareholder buyback or share buyback, quality balance sheet, proven management. We'd like to have global businesses. We don't want to overpay them for those assets. And also we don't want to own assets that are too expensive. We stay away from headlines. We really don't want to be swayed by them. But some of the adjustments we've made, rising interest rates, we have to recognize, and whether transitory or permanent doesn't really matter. The fact is, rates have gone up, and they have an impact on asset prices, and that those higher rates will have an impact on consumer spending, and specifically housing and inflation. Those are key indicators for investors, and we want to look at migration both globally and nationally. Housing prices in Canada and elsewhere seem to be coming off. So it's not good if you bought a house last year, but from a global macro perspective, you don't want assets to be too expensive in the sense that they impede on consumer spending. And then the pace of the recovery, the K recovery in the sense of the difference between the upper socioeconomic strata in terms of their ability to mitigate, if you will, what's going on economically versus the lower strata demographics, and that plays into the labor markets and consumer spending and government policies, and that's certainly the most difficult one. I started with that, and I will end with that. They're the hardest to understand, and they're the hardest to predict, and they can also have a significant impact on whether it's interest rates or the economy in general, which by ricochet would be the equity markets. So thank you again for watching. If you have any questions or comments, feel free to drop us a line. Thanks again for watching.